Ladies and gentlemen, good day and welcome to the L&T Technology Services Q2 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pinku Pappan, Head of Investor Relations, LTTS. Thank you, and over to you, sir.
Thank you, Faizan. Hello, everyone, and welcome to the second quarter FY22 earnings call of LTTS. I am Pinku, heading Investor Relations. To those of you who have joined from India, thank you for participating at this late hour. Our financial results, investor release, and press release have been filed on the stock exchanges and are also available on our website, www.ltts.com. I hope you have had a chance to go through them. This call is for 60 minutes. We will try to wrap up the management remarks in 20 minutes and then open up for Q&A. The audio recording of this call will be available on our website approximately 1 hour after this call ends. Let me now introduce the leadership team present on this call. We have Amit Chadha, CEO, Abhishek, COO, and Rajiv Gupta, CFO. We will begin with Amit providing an overview of the company performance and outlook, followed by Rajiv, who will walk you through the financial performance. Let me now turn the call over to Amit.
Sure. Thank you, Pinku, and thank you all for joining us today on the call. We hope all of you are safe and healthy and things are improving. In fact, I'm in our offices in Mumbai, visiting our centers later this week in India and next week. And I do believe this is a sign of returning back to normalcy, whatever normalcy is now defined as. As you may be aware, on September 23rd, 2021, we completed 5 years as a publicly listed company. I and the management team of LTTS would like to acknowledge and thank you for your continued confidence in us. During Q2, we held our Investor and Analyst Day, where we outlined our vision and steps and strategy to get there. We also talked about our 6 big bets in the areas of electric autonomous connected vehicles, 5G, MedTech, digital products and AI, digital manufacturing, and sustainability. I am happy to share with you that we are progressing well in terms of deal traction, pipeline, and solutions in these areas. The key highlights of our Q2 performance are, in USD terms, we had a sequential revenue growth of 6% quarter on quarter in constant currency terms, driven by healthy traction in digital across all our 5 segments. This was the highest quarterly growth we've notched up in the last 3 years period. Our broad-based growth was accompanied by a rise in EBIT margin, which at 18.4% is the highest we have reported. The large deal pipeline and conversions remain healthy. In Q2, we won 9 deals across all segments, out of which 5 deals were 10 million plus and 2 deals 25 million plus. Let me now provide the segmental performance and outlook to you. Starting with transportation, we had a sequential growth of 6.2%, led by good demand across all 3 subsegments: auto, trucks, off-highway, and aero. Auto companies are going through rapid transformation, and we are partnering with them in the areas of electrification and connected vehicles. We are ramping up with the traditional OEMs and Tier 1, but also deepening our engagements with some of the new age names on the EV side. In trucks and off-highway too, we are seeing customers modernize at a high speed, and we are winning deals in electrification programs across product categories like trucks, RVs, off-roaders, etc. Our EV lab, based in Bangalore, backed by end-to-end domain expertise, is generating a lot of interest with customers and is helping us win larger deals. In Q2, we won a 25 million plus deal to expand an auto customer's design center in India and create a dedicated technology hub to work on EV and power electronics. Switching to auto, we are seeing signs of a recovery, with the deal pipeline steadily improving as customers invest in connected solutions and data analytics to provide and improve operational efficiency. Summing up, We expect the growth momentum to continue in transportation across all three subsegments. In plant engineering, we had a good quarter with 4% Q-on-Q growth driven by ONG and FMCG, followed by chemicals. In ONG, we continue to win new engagements with major ONG customers as their global partner for site sustenance and digital engineering. In FMCG, the traction continues with wins for us in the areas of automation, line expansion, and sustainability. In chemicals, we are seeing EPCM services opportunities as the capex outlook improves. Overall, for plant engineering, we continue to see a good set of opportunities that will drive growth in the coming quarters. At industrial products, we had a second consecutive quarter with 8% or more in Q-on-Q growth, with all three subsegments showing good growth: electric, machinery, and building automation. The trend for platformization, servitization continues as customers invest in software platforms to improve their own products and to extend better features to their end-to-end end customers. We are seeing broad-based demand for collaborative and intuitive products, leading to digital initiatives like digital twin, analytics, and AI-led decision-making. Customers are opening up to engage partners like us, leading to continuous wins in deal flow. We expect IP to be one of the fastest growing segments this fiscal. In telecom and high-tech, growth was a bit muted with Semcon and telecom infra growing well, although there was some softness in media due to delays in project renewals and ramp-ups. In lab as a service continues to expand as we ramped up some of the recently won engagements. As 5G deployments happen, investments are being made by companies across multiple segments: computing, communication, consumer electronics, satellite-based streaming providers, Semcon, etc., to build newer products and platforms. In media, we won a 25 million plus deal to build a software platform for a new customer that partnered with us to accelerate time to market. Overall, we are seeing a demand and expect growth traction to improve in the coming quarters. Lastly, in medical. Medical has shown a strong bounce back in Q2 with nearly 10% sequential growth, and I'm happy and proud to share with you that our youngest baby at vertical has crossed the 100 million annualized revenue run rate milestone. This is a testament to our deep domain knowledge, our differentiated solutions, our amazing leadership and teams that have helped us gain market share and become strategic partners to our customers. In terms of demand, we are participating in building software platforms of digital health, robotic surgery and patient monitoring, as well as quality assurance and compliance. With supply chain issues in chip and electronic parts affecting our customers' ability to meet demand, we are also helping them resolve the problem of designing alternative components. Overall, we do see a good pipeline of opportunities in medical that will help continue the traction. Now, a few highlights on digital engineering and technology progress. Our digital engineering revenues were 55% in Q2 versus 54% in Q1. We see this trend continuing. On the innovation front, our engineers continue to innovate and file 25 patents in Q2. Our patent filings have been largely in the collaborative and intuitive spaces in digital. This past quarter also saw us being ranked by ISG as a leader in IoT consulting and services, and by Zinnov as leader in autonomous connected electric and shared mobility automotive engineering. Related to our overall talent scale-up, we have substantially increased the fresher intake, which in addition to optimizing the pyramid, will help us tackle attrition. Leveraging the Global Engineering Academy that was set up by our COO earlier last year, we have tied up with top universities to source and proactively train talent so that they can be productive faster. There will be a bump up in headcount growth in Q3 and Q4 as these freshers are inducted in the company. Let me now discuss the outlook. The demand outlook in US and Europe continues to be strong, while ROW and India are seeing signs of recovery. In our conversations and recent face-to-face meetings with customers, we are getting positive signals on FY22 budgets as CTOs, COOs, heads of engineering, etc., want to partner with us as they invest in growth and transformation. There are worries, however, about the current supply chain issues, labor shortage, and cost inflation. At this point of time, it is not clear if these worries are temporary or they could stretch for a longer period. But it is something to be watchful about and that we are monitoring closely. Q3 has some seasonality on account of furloughs and shutdowns. We believe broad-based growth is likely to continue, and any furloughs beyond normal are likely to be specific to certain customers rather than across the entire segment. As we cross the fiscal half-year mark and with the benefit of better line of sight, I am happy to raise our revenue growth guidance for FY22 in USD terms to be between 19 and 20%. Finally, to celebrate the 5-year listing milestone, the company has declared a special dividend of rupees 10 per share. I wish you all and your families a very happy Diwali in advance and would like to now hand over to our CFO Rajiv. Rajiv.
Thank you, Amit. Greetings to all of you. I hope you and your families are keeping safe and healthy. I'm pleased to share a strong Q2 performance with healthy improvement across all parameters: revenue, EBIT margin, PAT, and free cash flows. With that, let me take you through the Q2 FY22 financials, starting with the P&L. Our revenue for the quarter was 1,608 crores, a growth of 5.9% on sequential basis. Our double-digit year-on-year growth trajectory continues, with Q2 revenue up 22% on Y-on-Y basis. We touched a new high on EBIT margin at 18.4%, making it the 5th consecutive quarter of operating margin improvement. The 110 basis points sequential improvement in EBIT margin to 18.4% was driven by operational efficiency measures, including productivity improvement and cost optimization that helped to absorb mid to senior level wage hike impact. Second, scale benefits realized from account mining driven growth. And thirdly, favorable depreciation and amortization as a percentage of revenue. Moving to below EBIT, other income was lower on sequential basis due to reversal of SEIS accrued income taken in FY21. As you may be aware, the Government of India recently notified FY20 SEIS incentives, which have now been capped at 5 crores. FY20 SEIS incentives were accrued in FY21 as per the then prevailing incentive rate of 7%, hence the need for reversal. However, we could partly offset the SEIS reversal with higher forex gains resulting from appreciation of rupee against dollar, which moved in a range of 73 to 75 during the quarter. Going forward, income from SEIS incentives will not be material for LTTS anymore. Our effective tax rate for Q2 was 26.6%, flat on a sequential basis and in line with our full year ETR expectation of between 26.5% to 27%. Net income for the quarter stood at 230 crores, which is 14.3% of revenue, up 6.4% on sequential basis, driven primarily by higher revenue and operating margin. Now moving to the balance sheet, let me highlight key line items. DSO was 85 days end of quarter 2, remaining flat versus Q1, while unbilled days improved to 15 days in Q2 compared to 27 days in Q1. The combined DSO including unbilled stood at 100 days, which is an improvement versus Q1, but slightly above our target range of less than 95 days. We expect further improvement in the coming quarters. Talking about cash flows, because of the improved DSO in Q2, our free cash flow also improved to 423 crores for year to date, a healthy 95% of net income. Our cash and investments rose to 1,958 crores end of quarter 2 FY22. Amit already talked about the dividend. I'm once again pleased to share that the board has declared a special dividend of rupees 10 to celebrate 5 years of LTTS listing on the stock exchanges. Moving to revenue matrix, on a sequential basis, dollar revenue growth was 5.7% in reported terms. and 6% on constant currency basis, with all 5 segments growing as highlighted by Amit. Growth was led by industrial products and transportation segments. The segmental margin performance was better in 3 out of the 5 segments on a sequential basis, with transportation and telecom and high-tech continuing the path of improvement for the past 5 quarters consecutively. Now let me comment on operational metrics. Utilization reduced slightly to 78.1% because of strong hiring undertaken to fulfill demand and to improve pyramid. We target to maintain utilization within the 78 to 80% band. The on-site offshore mix continues to improve favorably towards offshore at 59.2% versus 58.1% in Q1. The T&M revenue mix increased to 70% in Q2 and is likely to stabilize around these levels. Client profile, which is the number of $1 million plus accounts, showed a sequential improvement in all categories, 1 million plus to 30 million plus. As we indicated in the past, owing to the LTM nature, the client profile numbers have started improving from Q2. This trend will continue in the coming quarters. Moving to client contribution as a percentage of revenue, here again, on a LTM basis, the improvement is visible in top 5 and top 10 clients. Headcount increased by 1,011 employees sequentially, while attrition moved up to 16.5%, which is now an industry-wide trend. We are proactively taking various employee engagement measures to contain attrition. Our realized rupee for Q2 was around 74 to the US dollar, a depreciation of 0.2% versus Q1. Before I end, let me give some color on the EBIT margin trajectory we see going forward. During our Investor and Analyst Day held in September 2021, we share our aspiration to reach a $1.5 billion revenue run rate and 18% EBIT by FY25. While we have achieved EBIT of 18% plus in Q2, there are a few headwinds that we will have to manage. First, with improving economic recovery, we anticipate that temporary savings from travel and facilities-related spend could gradually be given up in the coming quarters. Second, the current demand environment may lead to slightly higher than normal headwinds from attrition and wage hikes. Finally, we plan for organic and inorganic investments to support growth. Therefore, the margin trajectory is not going to be a straight line. Having said that, our aspiration is to move towards a sustainable 18% EBIT margin level by FY25, and we see a path to reach there. We will continue to work on improving operating margins using levers like growth, quality of revenue, and productivity improvement. As I conclude, I would like to thank you all for your continued belief in us, and wish you all a happy festive season ahead. Moderator, we can now take the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The first question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Hey, thanks. Good quarter, guys. Amit, just 2 quick ones from my side. First, on the attrition side, your attrition performance this quarter clearly was much better than what other Indian IT services companies have reported over the last few days. But have you seen any, cancellation or loss or probably push out of some of the business to third quarter, which is giving you the confidence in your growth trajectory, despite the furloughs which are coming up in the December quarter?
Sure. You said two questions. So was there a second one?
Yeah. So second one was on the margin side. 18.4 is a fairly sharp pickup. Do you expect to continue to benefit from operating leverage in Q3, Q4 also, or do you think your hiring plans over next 2 quarters will kind of bring it down from current levels?
Okay. So let me address the first one and request Rajiv to take the second one. So the first one, on attrition, I do want to acknowledge, Mukul, that it's been a tough time for us, right? On one side, we've had deal wins, and the curated vision that we had created for ourselves around 6 dimensions and 6 bets has caught traction, and we've seen deal wins happening therefore, right, and solutions being there. At the same time, there's been attrition, right? I want to compliment the work done by our middle management across delivery organization, sales organization to manage some of this. And I can share with you proudly and humbly that we haven't had client cancellations because we lost people, right? So that hasn't happened. But yes, I mean, could we have done, could things have been more? Had we had lesser attrition or we would have been able to hire faster? There's always that plus and minus that continues to happen, right? We have to be mindful. We don't want to hire in advance to demand so much that we get into a problem. So there has to be a balance we have to find, and we have worked in that balance, right? So that's number one. Number two is, from a hiring standpoint, I want to confirm that we have got on board 1,200 freshers in the last 2 quarters, and we are going to be taking another 2,000 freshers in Q3 and Q4, loaded largely towards Q3. So you will see Q3 headcount going up from a fresher standpoint. If you remember, Mukul, we had set up a global engineering academy or training academy. So it's done by our CEO last year. That has come into good use. From one side, our CHRO has done an amazing job in widening the net to colleges that he has been able to get, and people he has been continued to get for us, and ramp up a lateral hiring engine in the US, in Europe, and in India, right, and Japan. And on the second side, the head of training academy as well as all the business units has really taken advantage of this global engineering academy to take people in, keep open minds, and then starting to deploy them. So all of that, if you ask me, is going to help us as we move forward into the year. Again, do I have all the answers? No, but we continue to work around our axis to see how we get there. Margins, Rajiv, to comment.
Sure. Mukul, in terms of margin, I think your question was, will we continue to see such a sharp spike going forward? So what?
Rajiv, it was about whether Q3, Q4 should see a moderation versus Q2 because of the new hires coming into the system.
Sure. So, I would call out, of course, the tailwinds and the headwinds, right, which is, of course, where we've got to balance it out. So one, in terms of growth and the quality of revenue, is going to be a major lever in terms of improvement on margin. Also, that will lead to economies of scale like we've seen in Q2. The second is, if you look at productivity improvement, and that's been one of our consistent ways of improving margins, that's another area that we'll continue to look at. The third is around the segment mix. We talked about improving margins on transportation segment and telecom and high-tech segment. Transportation, we are now in the range of 19% plus margins. Telecom and high-tech has also started to show improvement. We believe we've got further headroom around telecom and high-tech, and that will show improvement in the coming quarters. So these are some of the tailwinds that we have. In terms of the headwinds, like I said in my opening commentary, there are going to be, of course, challenges to deal around attrition, and there could be wage hikes that we will have to deal with in the coming quarters, and that's going to be a balance to strike. The second is, there could likely be inorganic investments that we make to support growth. And finally, we may see travel come back in the coming quarters, not in entirety, but it will gradually start to show up. So that's where it is. We will balance this out to be able to see how best to manage this operating margin trajectory.
Thank you. The next question is from the line of Pankaj Kapoor from CLSA. Please go ahead.
Yeah, hi, thanks for the opportunity. Amit, my first question to you on the longer term outlook for the growth. Near term, we have a very strong visibility, and that's the reason why you have taken the guidance also up. But if I just try to extend it further, what are the typical markers one should look at? Your deal win is good, but it is broadly in line with what you have been doing. So anything else which I should be looking at to take a view on how the revenue growth could be, say, on 23, 24 onwards?
Sure. So, Pankaj, longer term, right, our business is built on consumer demand. It's built on, so if products are consumed, if products are manufactured, we are in business, right? And that's what is the basis, or we are one. Second, when the demand patterns shift or there is flux, if I may call it, in the market or in the demand, it is good for us because it creates opportunity, right? So as I see it today, I'll share the tailwinds that I'm seeing, right? And then I also share the headwinds very honestly. So the tailwinds I'm seeing right now are around in transportation. There's demand in electrification, in auto, in trucks, as well as connected vehicles. And I'm starting to see electrification conversations in aerospace, right? So that's one. Second, in medical, I'm starting to see people talking about home care, miniaturization of devices, bringing things, making it easier for a patient to do a lot of self-diagnostics, etc. Telemedicine. So that's the second that I'm seeing as a tailwind. Third, industrial products. We continue to see demand for digital products, digital services, digital engineering, if I may, and digital manufacturing. Right. Right. So there are three clear areas. Now let me come to the not so, or for us, right, and others could be different. In plant, people are starting to talk about new capex. Oil companies are talking about upgrading stuff, etc. But that money has yet to hit the market, right? So one, people talk about sustainability across, but that money has still to hit the market. Third, on telecom, 5G has been a buzzword for a very long time, but money still has to start flowing like it's flowing in transportation today, right? So that's where it is. Digital manufacturing, digital products, we continue to see around connected, collaborative, intuitive. You've talked about it. I won't spend more time, but it's moving towards intuitive and collaborative. Finally, the headwinds, and I called it out in my remarks as well, is that today if you look at CEOs of large companies and our customers that I've been meeting in the last few weeks and talking to, and chief operating officers, their mind space is clouded and they are thinking about supply chain a lot more than they used to. So that's one thing I don't know how it will play out. So longer term, I am reiterating what I had said in our IAD, Pankaj, that we are confident to get to $1.5 billion in FY25 as a run rate. So that still stays. And we'll continue to update you. We'll continue to talk on how things go forward.
Thanks for this, Amit. That's very helpful. Just one clarification. Do you sense that there was some pent-up demand this year, which, of course, while structurally things all remain good, may probably normalize next year?
So, again, it will depend. So Pankaj, very clearly, we've been looking at quarter-on-quarter growth rather than annual, because last year was a very low base. We all know we had a bad year, right? So we're looking at sequential growth is how we charge our teams internally on. Though they look at long-term for solutions, which is a 2 to 3 year period, service offerings are like annual, and then performance and execution is quarterly. So I would be fairly comfortable at this stage to say that maybe there was a little bit of pent-up that was there earlier, but I do see this demand to be there for some time.
Thank you. That's very helpful. Just one small bit. How many of your employees are now back in office?
Thank you for asking that. We've got about 26% of our employees that are back in office. There is no formal mandate or dictate to come back. Our HR, our delivery teams have worked, and function teams have worked very carefully to make sure that we make it a safe working place. And we are nudging people back to come back. I do believe longer term, so because before you ask that, so the way we are modeling this is, I do believe that once we are past these waves and all that, I do believe that you will get back to about 80-90% back to office, but that's where you will be. Smaller cities like Baroda, Mysore will go to maybe 90%. Bigger cities like Bangalore, Mumbai may go to 80%. That's where it will be. I don't see 100% coming back, but we are at 26% right now, and we are. So our focus is not to get people back in office. Our focus is to make sure people are safe, people are vaccinated, and once we get them completely vaccinated, we will start prodding people to come back further. Just last point, we lead from the front. So I'm going to be in India. I am in India already. Our offices in Mumbai this week, and Bangalore, Mysore, and there are leaders that have traveled from overseas, plus the leaders that live here, that are traveling to other locations. So we are trying to lead from the front and create this effect that it's safe to come back. If we are here, you can come back as well. We are not making big tall claims, nor do we want to make any press releases about this. We will work it in our way, but we will get it done.
Thank you. The next question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead.
Good evening, sir. Thanks for taking my question, and congrats on a great performance yet again. Amit, two questions from my side. One is just wanted to pick your brains on the auto segment. I know you've already talked about it at length, So just wanted to check basically on the auto segment. Has there been a difference in the kind of engagements or in the kind of demand that we have seen pre-pandemic and post-pandemic? I mean, in the kind of nature of work, or let's say a more shift towards the electric vehicle part, has that got a spurt? So any changes that you might have seen in the auto segment, which is potentially different from pre-pandemic levels? And my second question was on an interesting number that I just wanted to pick your brains again on, is on the fixed price contract share of our revenues. So that number has actually been coming down over the past few quarters. And at the same time, of course, our digital share of revenue has also been increasing. So is this just a correlation or a causation here that is leading to a higher T&M in terms of what percentage of revenues? And if not, that any specific reason that you would want to call out for the fixed price contracts coming down?
Sure. So let me address this question in three ways, Vibhor. One, I'm going to talk about the overall pre-post on auto. I will request my colleague Abhishek, who's here, to talk about some of the solutions that we're building that is helping us in that journey, and then Rajiv will pick up the FP and T&M. So auto segment pre-post, I'll tell you one thing that happened was, and immediately, knee-jerk, the moment the pandemic hit, which was March, April, May, I was talking to the head of engineering and the head of, one close friend was head of engineering and supply chain, right? And he was saying, I don't see NOS coming back for the next 3 years. I don't see that. And immediately they stalled, they stopped, these engineering development programs, or delayed it, right? And that's where we got hit. And they said, we don't know whether we will sell or not. That was pre-pandemic. Or pandemic, in pandemic, right? Pre-pandemic, there were projects, and they were always, as you are aware, the design cycle is generally about, so if they want launch something in 3 years, they do the engineering now, then it goes through whatever, and we get engaged in that 3-year prior period to what you see coming out, right? 2-3 years. So pre-pandemic is continuing. Also, the amount of discussion on electrification and autonomous, there was discussion. Infotainment, there was a lot of discussion. But electric as well as autonomous, there was conversation, but there was not a huge amount of conversation. Come post-pandemic, or we're not even post-pandemic, I'm saying post-April, May, June, the moment they realized that people are not stopping from buying cars, actually people were buying more cars because now they wanted their own ride. They didn't want to sit in a bus. They didn't want to sit in a train, right? So they saw that happening. Immediately, the conversation shifted to how soon can you start getting stuff done, A. B, the amount of conversations and the amount of work that we are getting now in electric and connected area is there is a huge demand that we are seeing right now, and everybody wants it like yesterday, right? There's an adage that we use in consulting language. It says, hurry up and wait. So it's been the other way around, where we've had to, it's all of a sudden, right? And we're working towards it, and that's part of the training, etc. we're doing. Second part of it that we've seen is solutions that we've built on, especially EV. And I'm going to request Abhi to spend a couple of minutes about it, and then we'll hand over to Rajiv on FP and TNM. Abhi?
Yeah, thanks, Amit. So I think what we've done on the automotive sector, especially with regards to investments over the last, I would say, 1.5 years, is paying us off very well. We did investments in two segments. One is internally, we have structured ourselves by practices, powertrain practice, connected, autonomous, body engineering, vehicle electronics. And each of these practices have very clear, detailed plans on investment areas. I'll just touch upon the EV front, which is something which is giving us great returns over the last few quarters. So we have a EV lab which we have spoken of in the earlier quarters, in which we invested quite a bit of money during the COVID times to set up this lab. What we have also done now is we have a complete, I would say, electric car we have developed. Now, when we say electric car development, it's not about getting into the car segment, but to demonstrate our capabilities on every element of what goes into electric car. The battery management system is our technology. The cable wire harnessing that has been done is ours. The vehicle control unit, power distribution unit, every component that you can think of in an electric car is something that our engineers have developed in-house. And we continue to enhance this. In fact, even the connected part of the car, where we have Alexa integrated in the car, and Alexa takes commands to stop various elements of the car unit, is something the engineers have done. So I think the way we are going about it is we are keeping ourselves ready to demonstrate capabilities to our customers. And Amit spoke about from business front, 6% growth quarter on quarter, and I think this journey will continue. We are seeing extremely good traction.
Vibhor, to answer to your question around the TNM mix, I think I've already touched upon it in my opening commentary. I mean, we are seeing the incremental signing happen on the TNM side. And this is more so because, when there is a greater share of, let's say, new technology or a generational leap in product or processes that customer is undertaking, we are seeing more of TNM kind of contracts being signed. For example, use of Scrum methodology. Our take is that we will be in this range going forward as well, Vibhor.
Thank you. The next question is from the line of Abhishek Shindatkar from InCred Capital. Please go ahead.
Hi, sir. Thanks for the opportunity and congratulations on a great execution. My question is, generally the perception was, ER&D firms have to have employees in office, but if I look at the offshoring mix, we are almost now at 60%. So, is this a structural shift in terms of clients engaging ER&D firms, and that offshoring can increase further? That's first question. And the second question is on the margins. What could be the key reason for lower than company average margins for telecom and high tech? Is it that it is more on-site driven business? Because we are not yet anywhere close to the peak margins, and how much of that is a lever in the margins going ahead?
Okay, so Abhishek, the way we are seeing this is that all our customers, right? So I'm not talking about ones that where we do very small business, but our top 30, our next 20 customers, they have almost treated our employees as their employees. There is a new thing called envelope of health, safety, and HSC envelope. What HSC envelope means is, Abhishek, that whatever they do to their employees, they want it done to ours. That's how they want to operate. This is the principle. So if they don't have their employees coming, they don't want our employees coming to office, right? And they have gone through great lengths, and I thank our customers and our partners that having done that, where they are enabling this work from home, right? So we're thankful to them for having enabled that. Now, having said that, short term, you've seen offshoring improve. You also know that countries had shut down their visas, etc., etc. We were not able to fly people in, recruiting locally, blah, blah. I do believe that a little bit more offshoring could happen. I mean, that's to be seen, how things develop, right? Because the point is, a lot of behaviors have changed over a period of time. Let's say all of a sudden, one day COVID goes away, right? Then how will people behave? I don't have that answer. But I do believe that whatever offshoring has been achieved is something that is sustainable, and we'll work to see as to how this can, further go in a direction, etc. Right? A. B. What we have done in terms of this is to make sure that we've been able to. So, you again said engineering can't be done remotely. That's not correct because, yes, there are some mechanical pieces of work, there is some embedded work, there's some plant engineering work that needs machines, that needs people in offices. But there is other stuff that can be done remotely, which is being managed. Again, do I have a golden bullet or answer for this? The answer is no. We'll continue to work on this. On lower telecom margins, again, I'll hand over to Rajiv to address.
So Abhishek, in terms of the lower margin on telecom high tech, I think this is something that we've called out in our earlier earnings calls as well. There were two segments that we were consciously working in terms of improving margins. One was transportation, second telecom high tech. Transportation, as you may have noted over the last 2 quarters, consistently we are able to see improvement in margin, and largely that is driven by growth and also optimization measures. As far as telecom high tech, we made conscious investments in telecom high tech, and that also follows from the fact that we did the Orchestra Technology acquisition Q3 of last year, right? So some of these investments have been deliberate. I may also call about investments in 5G. What we believe, I think those investments will now start to yield benefit. So the margin trajectory for telecom has started to move on the positive side. We believe in the coming quarters, it will be even better than what we see.
Thank you. The next question is from the line of Vimal from Union AMC. Please go ahead.
Yeah, thank you for the opportunity. Amit, my question is, just wanted to pick your brains on the industry growth for ER&D especially. Over the past 1 year, you've seen this industry take 2 rounds. I mean, we've come up from Q1 FY21 till today. In this 1.5 years, have you changed your view or have you increased? We've clearly seen growth increase for LTTS, but do you see this for the industry as well? Or the growth rate for this industry have pretty much remained where they were expected to be over the longer period, and you expect LTTS to sort of ultimately gain market share, and that is where the increased growth for LTTS is coming from.
So there are 2 things here, Vimal. One, and I'll refer to data from people like Zenov and IDC and market analysis they've done. So they're talking about that the engineering industry in 2020 was at about $1.5 trillion, right? Broadly about $1 trillion in legacy engineering, about $500 billion or $500 billion in digital, right? Now, if I look at view on say 2026, right? So I know that one of you also talked about a longer term view. So if I look at that, the expectation is that this $1.5 trillion will go to $2.6 trillion, right? The legacy will only grow at about 2%, but the digital will grow at about 19% CAGR. Now, all of this cannot come to people like us. It will go to captive centers. It will go to people like us. There may be Eastern Europe. It may go to, etc. But broadly, there's a increase in engineering spend that is seen that we expect to come out. Second part, this is also going to come out in different verticals. So be it transportation, be it industrial products, be it medical and healthcare, telecom, high tech. So each of these will have their own trajectories of growth in engineering spend, be it digital, be it legacy. And some digital may also start getting called legacy tomorrow. The second part is on the digital part itself. We expect that, so you broadly break up, if I may, digital into connected, collaborative, intuitive, right? 3 buckets. And where today 60% of the digital spend is getting into connected, people are still connecting stuff, and intuitive may only be 5%. If you look at $1.5 trillion when it gets to, we would expect connected to only be at about 30%, with the majority of the spend going into collaborative and intuitive. So I do think that that there is avenues of growth that is there from a spend standpoint. Now, from LTTS standpoint, there are 5 segments that we have agreed to work on, and there are 4 horizontal areas that we work on, that we have talked to you about. And we believe that as long as we can continue to build solutions, as long as we can continue to remain agile, think long term, plan medium term, execute short term, I do believe we'll continue to gain market share in the market in specific areas.
Fair enough. Thanks a lot, and all the very best for the rest of the year.
Thank you.
Thank you. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead. Nitin Padmanabhan, your line is in talk mode. Please go ahead with your question. As there is no response from the current participant, I have muted the line. The next question is from the line of Sudhir Guntupalli from ICICI Securities. Please go ahead.
Hey, thanks, gentlemen, for giving me the opportunity. Amit, just a starting hypothesis for most of us, analysts and investors, is that growth rates in ER&D tend to be higher than in IT services. But if we look at the FY21 performance and FY22 performance, expected performance rather, of LTTS, and kind of benchmark it with some of our services, IT services companies, or a couple of our sister concerns, so on and so forth. Clearly, the growth differential seems to be very wide for FY22. Now, this is despite the fact that FY21 has not been a very bad year for some of them, like it is for us. So on a 2-year CAGR basis, if I look at, we are running close to around 8%, FY21 and FY22, and this comes on top of FY20, which was also a weak year. So just trying to understand your perspective around, is anything changing in this cycle in terms of the expectation around whether ER&D growth rates can be higher than that of IT, or will those be lower than that of IT? That's my first question.
What's your second question?
Related to the same, again, we are running at around 8.5% sort of CAGR for the last 2 years, despite FY20 being very weak. And I think, referring to one of the earlier questions from Pankaj, there would have been some pent-up which would have come into the system in this year. Now, even after that, we are talking about around 20% sort of growth. Going ahead, when this pent-up kind of fizzles out, our guidance is sort of hinting at around 17-18% overall growth, in which I'm assuming an organic growth rate of at least around 14-15%. So how do you think about the achievability of those organic growth rates?
Okay, so Sudhir, if I may, I would request, don't take a base year of FY21, right? In fact, if you remember, you've been with us for some time, you would see. So after we went IPO, we did have a bad year at that point of time, where we had a certain, there was issues. The client, beyond that, we ran 2 years at successive growth rates that were above 20%, right, organic. And then we had a year where we had 2 client situations not in our control. Had those not been there, or if I was to remove those 2 client situations, we would have still been at that 20% clip, right? So not, right? Last year was an aberration. Look at us as a 3-year, 5-year CAGR. I would not look at it as a 1-year, 2-year, if I may, please. And having said that, engineering and technology industry is different from IT, right? And therefore I would look at us differently. Right? I do believe that each one has their own trajectory, each has their own nuances. We work out of a profit center. IT is largely a cost center play, and not a cost play, but a cost center play. Right? We are more on a innovation model. That's a difference. So there is differences there. So I would not do that. That's what I would say. One. Second, how do you see the 19 to 20? Is that good? Is that bad? Is something we'll see. I mean, we continue to work on our numbers. We continue to see where the opportunity is. We are focused right now more than a trajectory. We are focused on basic principles. I'm sorry, Sudhir. We are all engineers. We are focused on getting to technology, making sure we are competitive, making sure we are giving our clients their competitive advantage. And with the shifts in technology that we are seeing, we do believe that we are not at the top of the S-curve in terms of that it's done and the days are over. I do believe we are in a part of an S-curve that we'll see further climb.
Thank you. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, thanks for taking my question. Am I audible now?
Yes, sir.
Yeah, apologies. Just a couple. So one is, if I look at the attrition, I think the attrition numbers are something that we aren't used to. If I look at history, it is clearly at the top end. And first question is, do you think the attrition has peaked or you see this going up further? Two, are you seeing attrition more on the domain side or on the horizontal side of things, or is it just experience based attrition that you're witnessing at this point? Third, you spoke about wage increases. Just wanted your thoughts on you expect that to happen in the second half of the year, and so that was the third one. And finally, in terms of acquisitions, just wanted your thoughts on the areas of focus, and do you just expect tuck-ins like history, or do you expect a larger one? Those were the questions. Thank you.
Okay, so if I may, I got 16.5%, not good. Has it peaked or will it be more? Third was wage hike. Are you planning wage hike? What was the second question? Can you repeat that, please? Sorry, I didn't catch that.
Yeah, so on the attrition was higher than history, and will it go higher? Is it more domain specific or horizontal specific, or is just experience wise of 3 to 5 years or 1 to 5 years? So those were the questions on attrition, and obviously wage increase in the second half.
Sure.
Do you expect it to have a meaningful impact? So those were all on the attrition and wage. Maybe I'll ask the last question after that. Yeah.
No, M&A we got. So I'm going to request Rajiv to talk about M&A, but let me cover the attrition part for you. And then if I miss out something, my colleague Abhishek can add to it. So number one, we are not proud of 16.5. I want to be very honest with you. It personally hurts my heart when I see an employee go, because at some point I think, does he not believe in our dream? Does he not believe in our 6 dimensions? Does he or she not believe in our bets? But reality is, I cannot match dollar to dollar. This can't happen, right? Don't have an open wallet. Don't have an open checkbook. Number one. Number two, the opportunity in India and US and Europe has expanded. We had somebody talking to us. In fact, we had Satya Nadella talk to us on a subject, and he said the number of changes he's seeing on LinkedIn, he has never in his life seen so many people changing jobs. And they, of course, have access to data that you and I don't. And maybe you do, I don't, right? So I do believe that attrition, so again, do we think it's peaked? We are working various measures, and let me take some of those. Number one, we had a very bad year last year. We didn't give increments, but this year we divided it up. Juniors got increments in April, seniors got increments in July. The reason that was done was we wanted to make sure people understand that leaders don't eat first, they eat last. Second, We have done corrections where we have not been able to do enough, etc. But like I said, limited dollars, limited checkbooks on these things. So we have done what we could there. Having said that, we are trying to provide a holistic experience. We are running a program within the company called Project Rendezvous that is focused on trying to enhance, improve employee experience. 2 weeks ago, while we closed the quarter, the CHRO, the COO, the CFO, myself, the CTO, and the business unit heads, and some of the select sales heads sat down, and there are 130 people involved in the company that came and gave us suggestions on what do you need to do in 5 specific areas around Project Rendezvous, and we've given approvals to implement some of those. The others will get done over the next 3 months to be able to, we'll do a pulse check again on our employees in Q4 of this year. So we are doing that to provide a holistic experience. Third, while COVID is going on, we continue the process of CEO Club, Youth League, we created a Leaders League, on and on, to make sure that we are not just talking about dollar to dollar, but what are we doing beyond. Third, technical training was established, and that continues to enrich our employees as they move further. Now, are we going to do any further corrections? Maybe. We are working, we are studying the situation, and we will see what we have to do in specific areas, and we will make that intervention happen if it needs to be done. Lastly, on domain, it's been broad-based in terms of attrition that we've had. We don't give out data on city-wise, but we have gone down to city-wise attrition, gone down to business unit-wise attrition, and we are taking various steps to try and stem it. I again want to say, in spite of the attrition we've had, I'm proud to say that I lead a team that has made sure they can make things happen. It is nerve-wracking, but people are doing it. And we'll take various measures to try and improve it. Anything you would like to add before we hand over to Rajiv?
No, I think you have covered it all. I think just one point which at least we're getting very good feedback from employees is the broad-based training programs that we have done. More than 75% of our employees have been touched by at least one of the training programs globally. I'm not just saying India, globally, in the last 6 months. And that, I think, we're getting very good feedback on that from employees that we continue to invest in them.
And Nitin, having said that, I do want to say that our plan to address attrition is there. We've got backup plans, and we are working towards it. We are hiring freshers, we are training people, we are hiring laterally. So all that is happening. I'd given out numbers earlier to one of the questions as well. So we believe that we'll work this out. This is an industry thing, not just an India thing. It's an India, US, Europe combined thing, and we'll work towards it. Rajiv, would you like to take M&A, please?
Sure. So Nitin, I believe your question was, are we looking at more like tuck-in acquisitions? So let me clarify, and we've said this earlier as well in our IAD. So we are looking to do acquisitions to really build capability in the white spaces. And the spaces really is one on the auto new tech, the med tech, and ISV. The second is, while in the past we've done acquisitions more in the range of $20 to $25 million, we are now open to do even larger acquisitions. That could be in the range, say, $50 to $75 million range. And for that range, we believe that there could be capabilities that could, expand beyond the 3 spaces that I talked about, right? So it is not necessary that it's only going to be a tuck-in acquisition, but we are not closed, right? What we're looking to do essentially is to build capability in the white spaces, and that's the lens we're looking at.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Pinku Pappan for closing comments.
Thank you all for joining us on the call today. We hope we were able to answer most of your questions. I am available on email, so please write to me if you have additional queries. Look forward, as always, to connecting with you, and we wish you all safe times and a great evening. Thank you.
Thank you. Ladies and gentlemen, on behalf of L&T Technology Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.